Hey everybody, Chris Englebert with Englebert Financial Advisors in beautiful Allentown, Pennsylvania. And we're doing the Englebert Angle today. The title, as you can see, is Beware These Current Advertised Investments. What do I mean by that? Many of you, like myself, are typically driving down the road, listening to AM or FM radio, and all of a sudden you hear an advertisement comes on the radio, and in a onerous voice, you'll hear the voiceover artist go, "Beware of the stock market, crash-proof retirement, protect yourself from the downside," etc. I'm going to address some of these advertisements you hear on the radio because when I hear them, they really kind of get to me because they're really preying on your fear. And a lot of people don't understand what's going on out there. So the first one up that kind of gets me is the one you'll hear all the time on the radio talking about crash-proof retirement, how you can protect your retirement assets from a big decline in the stock market. What are they selling? They are selling a tax-deferred variable annuity inside of an IRA. The first question you got to ask yourself is, why are you putting an annuity inside of an IRA, which is already tax deferred? So we have a real problem with that because it's been a rampant practice the last 10 years where people come in and say, "Hey, Mr. Advisor, I'm concerned about the stock market going down. What should I do?" Lo and behold, not only do they sell you a tax-deferred variable annuity inside an IRA, which is a bad idea, they sell you something called an indexed annuity. What is an indexed annuity? They say, well, gee, what we're going to do is put your money in the S&P 500 index, but lo and behold, we're going to design it that if the stock market goes down, you lose zero money. What they don't tell you is that when the stock market goes up, you make very little money when the stock market goes up. And so what happens with an indexed annuity is that whenever you get in, let's say the S&P 500 is at 4,000, a year later it's at 4,000, you're going to end up making zero return on your money. And for the privilege of making zero return, you're going to make 3.5%, or you're going to end up paying 3.5% to 4% in annual fees. But wait, it gets worse. Many of these indexed annuities have commissions to get into them as high as 10 to 15% of whatever you're putting in. So for example, if you're putting in $200,000, let's say you leave your company, you roll over your 401k to an IRA, and a salesperson talks to you about a crash-proof indexed variable annuity, you're going to end up paying in commission anywhere from $15,000 to $20,000 to get into that. And what's even worse is they have an onerous back-end sales charge that may last up to 10 years. What does the back-end sales charge mean? It means that if you go to try to get your money out, you'd pay a sales charge again. Now, one of the other things we want to point out is that if you're in this indexed annuity and the stock market goes up big, so last year the S&P 500 was up 24%. Many of these products have big caps on them, which means you're only going to make a fraction of whatever the stock market goes up. Again, you're not going to lose any money, but I've seen some of these indexed annuities last year, stock market up 24%, they ended up with the cap only paying 5 or 6% return. There are a lot better investments out there. Then they turn around and talk to you about lifetime guaranteed income. And what they do is they put a rider on that says, if you start taking income after year 5 or 6, we're going to guarantee you so much income for the rest of your life. What they don't want you to do is start that lifetime guaranteed income early because you'd just be taking your own money out versus waiting for the balance to grow. So again, indexed annuities inside of an IRA are a bad idea. If anybody suggests putting an annuity in an IRA, which is already a tax-deferred account, question them why, but run the other way. The other thing is, if it's an indexed annuity, you have high internal fees and charges. We can provide a service where if you send us your indexed annuity contract, or if somebody's trying to sell you one, we can tell you what the annual charges are. We just did one recently where the annual indexed annuity charges were 3.5%. That's in contrast to what we charge to run an investment account of 1.25%. So you can see that this is not a good thing as far as an investment product goes. Now, the other thing that happens is you hear it on the radio, "This is Stephen K. Bannon, the digital currency. We are being attacked as far as the US dollar. You need to buy physical gold in your IRA." These advertisements drive me crazy because, again, they prey on your fear that you need physical gold in your IRA. You can go ahead and buy physical gold in your IRA now, but you got to understand, buying that physical gold, why are they constantly running these advertisements on TVs, which cost a lot of money to run ads on TV or radio? Because the commissions to buy physical gold in your IRA is as high as 15%. Again, you have a $200,000 IRA, you text them or whatever they want you to do, and they send you the paperwork, you're going to pay anywhere from $10,000 to $15,000 just to get into this physical gold, number one. Number two, what they don't tell you is you got annual storage fees. The better alternative is an ETF, exchange traded fund, GLD, that's been around for almost 20 years. GLD has an annual expense ratio of 0.40%. It is one of the biggest gold bullion ETFs out there. And depending upon where you custody your assets, you may end up not paying anything to buy it. Or even to sell it. So again, there's big alternatives out there, much less costly alternatives, and one of them is an exchange-traded fund with the symbol GLD. Again, it's not a recommendation to buy or sell, but remember, when you hear these ads where they're trying to scare the heck out of you, do some logical thinking and say, if they're running these ads on the radio over and over and over again, they must cost a lot of money. Somebody's paying for it. Finally, the other thing that we're concerned about right now is the new cryptocurrencies that are proliferating. So on January 11th, we had 11 spot Bitcoin ETFs coming out. So now Bitcoin is an accepted form of investment. It's much easier to invest. In fact, one of the Bitcoin ETFs, IBIT, the BlackRock product, has garnered over $1 billion in assets in 24 days. But what I'm very concerned about is that there is literally a daily release of new cryptocurrencies to try to gain dollar flow. You see them all the time. I've seen upwards of 10 to 15 of these small little cryptocurrencies. You know, obviously there's popular ones out there, Dogecoin, etc. And you got to be careful with these because they're very small, they're very illiquid, and you're subject to scams as well. So if you want to buy some Bitcoin, again, not a recommendation to buy or sell, you now have an ability to buy spot Bitcoin in the form of an ETF, which we think if you're going to buy it that way, that's a good way to buy it. So I want to sum up some of these things. First of all, again, if you know by my tone that we are against annuities inside of IRAs, there's no question about that. Why is the advisor recommending a tax-deferred account being put inside another tax-deferred account? Oh yeah, by the way, the big commission up front is usually the reason. Don't trust the ads you hear on the radio. If you hear something weird, too good to be true, it probably is. Give us a call. We can help you to debunk what's going on out there. And plus, know what you own. I have 3 rules for investing. I've had them ever since I started my career investing. Number 1, it used to be if you can't see it in the newspaper, you don't want to own it. That's not true. If you can't find the price on the internet, you don't want to own it. If you've got to email somebody or go to some arcane website to look for information, you probably don't want to own it. The second thing, my second rule is if it takes longer than a paragraph to explain what it is, you probably don't want to own it. If something is a stock, a bond, a mutual fund, etc., if somebody's coming to you with a multi-page presentation on what you're putting your money into, and at the end of the presentation, you don't understand what you're putting your money into, don't put your money into it. And then the third thing is liquidity. It used to be that if you couldn't sell something in 3 days, you didn't want to own it. Now the rule of thumb is if you can't sell it in 1 day, you don't want to own it. We custody at Schwab. We hold a wide variety of investments in our clients' accounts. They all have tremendous amount of liquidity where you can buy it 1 day, sell it the other. So these are some of the things I want people to be aware of, because when you hear these radio ads, they incessantly pound you that make you think that you're doing something wrong when you're not. And there's a reason why that they're literally out there trying to raise funds because they're trying to generate a lot of commissions and generate a lot of annual revenue. And most of the time, it's not a good thing. So that's our Englebert Angle. We'll be back soon. Talk to you later. Take care.